Good morning, student. In a previous video, we discussed about capital market and its instruments. Today, we are going to start the next topic of our chapter number 10, that is capital market. The term capital market refers to facilities and institutional arrangements through which long-term funds, both debt and equity, are raised and invested. The ideal ratio between debt and equity for every organization or a company is 60:40. The capital market can be divided into the two parts. Now, capital market is divided into the two parts. The first is primary and second one is secondary. Primary market related to new issue. New issue of shares and debentures. Secondary market is resale of pre-issued, पहले से ही जो issued है share and debentures in the market, which is regulated by SEBI, यानी Security Exchange Board of India. This is also regulated by SEBI, SEBI Exchange Board of India, because for any approval, for any new share, they have to be given take the prior permission from the SEBI. These new issues called IPOs, that is initial public offer, and the major point of distinction between the two markets are as follow. The first is participants. Participants means in the capital market the financial institution, bank, corporates, entities, foreign investors and ordinary retail investors from members of the public, RBI, banks, financial institution and financial companies. Individual investors through permitted to transact in the secondary market, they do not normally do so. The second is distinction between capital market and money market is about instruments. The main instrument traded in the capital market are equity share, debentures, and in money market we read about treasury bills, bill of exchange, that is commercial paper and certificate of deposits. Investments outlay, the investment outlay in the capital market in the denomination of 10, 100 and its multiple, and where in money market the huge sum of money can be invested for a short period of time. Duration, capital market deals in medium as well as long term capitals. On the other hand, money market is only deal with the short term investments. Liquidity, capital market securities are considered liquid investment because they are marketable on the stock exchange. Yes, it can be sold out when the investor need a money, but in money market there is a high degree of liquidity as there is a formal arrangement of this. Discounting Finance House of India has been established for the specific objective to provide ready market for the money market instruments. Yes, the next point is about safety. Capital market instruments are riskier both with respect of return and principal repayment, and money market is much safer with a minimum risk of default. This is due to the short duration of investing and repayment. Expected return, the investment in capital market generally yield high rate of return because the risk is greater, and this is the principle of the business, that higher the risk, higher the profit. And possibility of earnings is higher if the security is held for a longer duration. First, there is the scope of earning capital gains in equity share. Second, in the long run, the prosperity of the company is shared by the shareholder by a way of high dividend and bonus share. So, this is the topic of today, and rest of all we discuss in the next video. Bye bye.